So for the 11th time in a row, the Bank of England has increased the base rate of interest. It now sits at 4.25%. That is a 0.25 percentage point increase. And so this is the 11th time in a row this has been going on since December of 2021. Every meeting, every 6 weeks when they get together, the Monetary Policy Committee from the Bank of England, there's been a jump each time from that all-time low, that record low of 0.1% that had been set around the start of the pandemic. Obviously, since then, continuing to increase. Now, if you've seen these videos before, I do want every time there's one of these announcements, you'll be familiar with what's going on. But I'm going to take you through some of the thinking behind this decision, what they've said in their minutes, the Bank of England, what they think might be happening to inflation and interest rates in the near future and maybe beyond. And I'll tell you what that might mean right now for your savings and your mortgage as well in particular. So let's look at the decision itself. So there are 9 people on this committee and they voted 7 of them in favour of this increase. 2 of them voted for it to stay the same. And I think before this happened, there was a lot of speculation that it might not happen at all. There might be no increase because of what's been going on with Silicon Valley Bank in America and Credit Suisse in Europe. This idea that increasing interest rates was partially behind what had caused those banks to have those crises and fails and need to be rescued. But before that, a couple of weeks prior to that, they've been maybe sort of thinking, okay, this is what the markets and economists and analysts were saying, so that maybe it will go up to 4.5%, so an even bigger increase. So all this kind of change over the last few weeks of where we're going with it, until yesterday we had the latest inflation figures, which were for February 2023, looking at the price increases over the previous 12 months. And the expectation is they would continue to be falling, but they went up again. And now sits at 10.4%. Up from 10.1% in January, still down from that 11%-ish rate from late last year. But again, there was unexpected for this increase to happen. And I think that's where this has come from, really. So maybe, who knows, maybe it would have been a much, much closer margin there, whether it goes up at all or whether it goes up to the rate we saw or maybe even go up to a higher amount. But certainly that kind of thing is a big, big, big player here. The sort of expectation that although inflation, they thought it would be going down, it went back up. And a big part of that, actually, inflation, if you look at the figures, is down to food inflation. And we've all seen that, haven't we? Where we're at the supermarket or eating out, it's got really, really, really expensive. And it's been passed down to us to when we're paying for those things. And that obviously has a big impact on that inflation rate. So that's kind of where I think that's come from. They kind of say, right, we still need to do something to get inflation under control. Their desire is to get it down to 2% at some point. Now, they didn't give in their minutes this time any kind of real figures. They sort of referred to previous minutes and all these things. It's a bit dense, a bit complicated. But what we do know is that they expect in quarter 2, so April, May and June of this year, that there will be an even larger drop in inflation than they previously had anticipated. So although we saw a peak, another sort of jump up on February's figures, they think it's still going to carry on going down over the next few months. Couple of reasons for that. Obviously, it's been more than a year since the war in Ukraine and the impact that's had on our energy prices overall. That's already been sort of baked in and factored in to those rates we've already seen. So prices won't be going that's huge amounts again. They're still going to stay high. They're not going to drop, but they're not going to sort of increase in the level we've seen them over the last year because of that. And also the energy price guarantee being extended for another 3 months. Spoke about that in my video talking about the budget last week, so check that out if you're interested. But that basically means that the average bill, and this is all very complicated, I won't go over it again, the average bill for your energy for a year, which doesn't work properly either, will be £2,500 rather than the anticipated increase to £3,000. So basically, because that hasn't happened, that's not happening, it means the inflation won't be going, will be able to fall at a faster rate than previously thought. So if we see that happening, inflation dropping off more substantially in quarter 2 than expected. And we had the figures last week from the Office of Budget Responsibility saying they think inflation will drop to around 2.9%, at least below 3% by the end of the year. Then you could take from this that as we go through the year, we might not need to see any further interest rate increases. Now, I say this every time, we just don't know. Like a minute ago, I said we didn't know what was happening a week ago, and 2 weeks ago, the analysts have been sort of predicting different things. So again, we don't know. But what the minutes suggest and what analysts are saying in response to that is that we may well have peaked, because if inflation does drop, they want it to be at 2%. That's their target. They won't necessarily need to increase interest rates again. Maybe 4.25% is where we'll peak. But in the minutes themselves, they do say that the market is anticipating an increase of maybe slightly above 4.5% in August time. So maybe what we'll see is this increase has happened. Maybe nothing will happen at the next meeting in 6 weeks in May. Maybe nothing will happen in June, the meeting 6 weeks after that. Maybe it will stay where it is, but maybe then in August there'll be another 0.25% increase, percentage point increase. Maybe. We just don't know. Don't know at all. So I know it's a bit frustrating, kind of think, is things going to get worse? They're going to stay as they are. Current thinking, maybe we've peaked. Still a chance for it to go up again. But things are always changing all the time. You never know. I doubt there's any sort of demand for a short-term increase in the short term, but maybe longer term there will be as we go into next year. Maybe rates will start to fall down at some point. I'll obviously update you whenever we have more information every 6 weeks when we have these minutes and these meetings. That's basically the decision. That's what's happened. Let's talk about what that might mean for savings and mortgages. Well, let's do mortgages first of all. And in fact, if you're a renter as well, this could have an impact on you because obviously your landlords, they may well have a mortgage. Generally, if you are on a fixed term mortgage, well, not generally, if you want a fixed term mortgage, that is not going to change because you are locked in for a certain rate, right? So that is not, your bills will not go up, your mortgage will not go up. However, when that fix ends, you will be very likely be facing a much, much higher rate than you got when you fixed. What's interesting here is we've started to see mortgage rates drop. So although we've seen the interest rate continuing to go up, base rate continuing to go up since, over the last sort of 15, 16 months, though since the last 6 months, the mortgage rates have started to drop because if you remember that awful mini budget we had in October, that saw mortgage rates soar up massively. So they were going up normally with the base rate, then they went up massively, and then they're starting to sort of go down slowly. So they're still nowhere near where rates were over here. Okay, they're still a long way from those low rates, and you're not going to see that happening anytime soon. But they are starting to go down. So what will be interesting to see is what do fixed rates do knowing about this latest increase? Have they already been priced in? Possibly, probably. What happens if there is another one? Will they go up again? Or will they continue to kind of recover from that weird peak we had before? So if your fix is coming to an end anytime soon, I would talk to a mortgage advisor, a mortgage broker, get their view on things. Is it worth fixing now? Or is it worth seeing if they continue to drop down? Now, one of the good things you can do if you are already on the end of a fix, 3 to 6 months before it ends, you can talk to a new provider. You can start to get potentially some deals in principle agreed. And often you aren't tied into them. Just watch out for fees, but you might be able to get something locked in at a fixed rate now. And if they do continue to decrease, despite the Bank of England base rate increase, bear with me, right? Then maybe you can just scratch that deal and start again. Just be aware of how many payments you might have made up front or anything like that. But have a look at those, talk to mortgage brokers, get an idea of what to do. Now, if you're on a variable rate mortgage, there's a good chance that will go up as a result of this increase. They don't have to pass it on, but the banks generally do. If you're on a tracker rate mortgage, which tracks the base rate, then you absolutely will see that go up. Probably within the next few days, you'll get a letter or email telling you that that is what's going on. So you'll be paying more almost instantly. Savings, on the other hand, this increase is good news. Should hopefully see rates improve again, but we aren't guaranteed to do it. As I tell you every time we have these, don't just assume because the interest rate has gone up on the Bank of England base rate that your savings rate will also increase. It's a good opportunity to have a look at the best buy tables. Again, loads of these over at becleverwithyourcash.com/savings. I update it once or twice a day with the best rates. See if there's anything that can beat what you currently have. You might think, oh, hang on, let me hold off because there's only one account out there, I think, maybe a couple which are tracking the interest rate for savings and they will automatically go up. There aren't many that do that. The others, if they're going to pass it on, they might take a few weeks. But it depends, when did you last look at stuff? If you're looking all the time, maybe wait and see if a couple of weeks, a couple of days, see what happens. If you haven't looked for a long time and you look at your account now and you go, you'll get in anything, I would say below 3% because the best rate at the moment is 3.4% for easy access, then it's well worth jumping on it and getting that. And again, I can't guarantee this, but broadly, there are a couple of banks right now trying to kind of stay at the top. So when an interest rate increase happens or another bank pushes their rate up to match it, these ones go back over it to try and be at the top of the tables. Now, no guarantee they'll continue to do that, but it's a good hedge in your bet kind of thing. If they're already at the top or near the top, they want to be there for a reason. They want to get your money in there as deposits. So going with them now might mean that they continue to go even if someone else goes above it, rather than continuously jumping back and forth with different accounts. That's easy access at least. One interesting thing to talk about here though is fixes, because the last couple of videos when we've talked about this, I've said how the fixed rates have been falling. They were very, very high back in sort of October, November time, but then started to decrease. And that's because fixed rates, again, same with mortgages, but also with savings accounts, they are based on predictions of where the rate is going to be. When the rate was predicted to be peaking at 6% this summer, that's when they started going higher and higher. When that was very, very quickly reevaluated after that crisis of that mini budget, then you start seeing them gradually sort of drop down as that peak started to fall again and again. So therefore I was saying, look, if you're going to fix, it's unlikely that we're going to see those rates improve. So you may as well hedge your bets. There's always a risk that they would get better, but hedge your bets. Even if there were future increases to the base rate, the fixes might stay where they are or continue to fall. But what we've seen over the last few weeks, since the last announcement, certainly, but definitely the last few weeks, a few banks really pushing that up. Again, I think more of a marketing push rather than passing on the base rate increases to you. But you can now get 4.5% for a 1 year fixed. 6 weeks ago, it was 4.17%. That's a big increase. And again, you've seen that similarly on 18-month and on 2 year fixes and others beyond that. It's only 1 or 2 providers doing this, but when they do that, others do follow through. Now, I would imagine they are already pricing in this particular increase. So I wouldn't imagine there are going to be many more going above this again. Can't be certain of that. But again, if you are looking to fix, and if we are thinking that inflation is going to drop down to 2.9% by the end of this year, and if that means that interest rates do stay where they are, if not fall a little bit in the year next year, then it would be very, very, very unlikely that fixes will continue to go up. If anything, they might stop going down again. Again, I don't know for certain because it's not just about a very simple, here's an interest rate thing and they'll track it. It's all about marketing spend and a desire to get deposits for certain projects and all these kind of things that come into play as well. But certainly have a look at those Best Buy tables and see what you can do. In terms of any other sort of things where interest rate comes into play, particularly in sort of borrowing, so credit cards, overdrafts, things like that, it's unlikely we'll see any change instantly or at all. Really, you might find that loans become more expensive if you're applying for them anew. You might find that maybe the length of time you get 0% or the transfer fee on a 0% transfer card, that might not be as good as they have been. But again, broadly speaking, if you've already got deals, they aren't going to be changing there. So there you go. I'll be back with another one of these videos in 6 weeks. But in the meantime, loads of other videos here on the channel to help you get the most from your money. My name is Andy Webb. Thank you so much for watching. Until next time, cheers.